Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research. This is the latest monthly update of global monetary trends. I'll be talking quite a lot this time about China. There's been some concern in newspapers, backed up by research from the Bank for International Settlements, that China has too much debt and the excess of debt presages a period of economic slowdown, perhaps even of serious economic trouble. I'm going to dispute that. But before I come on to, I just want all these trends, I want just to mention that my book, Money in the Great Recession, has just appeared. The first of the Buckingham studies in money, banking and central banking. And it consists of contributions from 9 economists. I'm not going to surprise you, we don't all agree. And I suppose, having said that, we all agree that it is worth discussing whether a crash in the rate of growth of the quantity of money was responsible for the global downturn of late 2008 and 2009. And the cover has a rather nice picture of trying to do some detective work on this crash in money growth. And now, if you take this sort of analysis seriously, then the only reason you'd be forecasting a major downturn in the world economy from here would be, again, if there was a risk of a big crash in money growth. So what I want to do in the next few minutes is just to review the money growth patterns in the main countries to see whether this is indeed a risk. Let's start off with America. Now you can see in this chart that there was this plunge in money growth in 2008 and 2009. But since 2010, there's been quite a long period now, 6 or 7 years, of rather stable growth of money at a low rate. Now it's true enough that the rate of growth of money in America has slowed down in recent quarters, roughly from 4 or 5% a year, say, to 3 to 4% a year. Hardly a dramatic change, but a slowdown. And we do need to be concerned, just moving on now to my comments on this, we do need to be concerned that the Federal Reserve will press ahead with this program of quantitative tightening, of selling back the assets it bought in quantitative easing some years back, selling back its assets on too large a scale, which would cause the quantity of money to fall. But I wouldn't get too alarmed about this, and I think that if the Fed realized that it was rather overcooking the goose, it would take the goose out of the oven, and I'm not too worried about that. I think one should expect in the next few quarters that that red line going sideways in this beautifully low, stable fashion will continue to do that. Let's look at the Eurozone. Yeah, again, you can see that crash in money growth, 2008, 2009. Then there was this quite long period in which the Eurozone banking system was struggling and was under pressure to raise more capital, and the growth of assets was held back, and the Eurozone did indeed have a second recession, not just the Great Recession, but also another recession back in 2013, and that was, I suggest, fundamentally caused by this very weak rate of monetary growth. Okay, well then, since 2014, they've implemented quantitative easing. There's been a big improvement in the macroeconomic situation. And again, you have this quite extraordinary straight line, 5% annual growth of brought money in the Eurozone towards the end of the period. What about the future? Well, the ECB is now tapering this program of quantitative easing. But I don't think they want to go back to where they were in 2011 to 2014, and I'd be surprised if we see a collapse in money growth in the Eurozone. So we've now had, I don't expect a collapse in money growth in America, I don't expect a collapse in money growth in the Eurozone. So where is all these worries about a collapse in money growth leading to another global downturn? China. Now, My verdict here is that China had this period of explosively rapid growth of its banking system, money, of output, and so on, say from 1980 through to about 2005. And since then, there's been a gradual reduction in the rate of output growth, money growth, and so on, except that in the middle there was this Great Recession, and there was this burst of money growth in China in early 2009. You see that period when money growth was up briefly to 30-40% a year kind of numbers. Since then, declining, not crashing. And if you look to the future, the People's Bank of China, their central bank, does have a target for monetary growth. And my guess is that if there was a major downturn in the economy, they would take action to boost money growth, get the banking system expanding again, as they've done in the past, in the last few years. So again, well, China we must talk about later, all right, because this is where there is some controversy, but my view is that there isn't going to be a big crash in money growth in China either. Japan, the point to notice about Japan is look at the axis. You'll see that there appears to be an increase in money growth. Couldn't it collapse on the other side? Well, actually, it's been an increase from kind of 0 to 2% a year to 2% to 4% a year. Okay, not very big movements. There is currently a bit of a slowdown in money growth. The last couple of months hardly amounts to a row of beans. It's not very likely that the Japanese banking system will start to contract in a major way, certainly not while the Bank of Japan is concerned to maintain positive monetary growth, so its program of what it calls qualitative and quantitative easing. Again, rather complicated and so on, but essentially I don't think there's going to be a big plunge in money growth in Japan. India. Well, they had this rather crazy attempt to deal with the back economy in November last year when they demonetized the 500 and 1,000 rupee notes. And that did lead to this plunge, sort of one-off collapse in the rate of monetary growth, but it wasn't actually it was more the nature of a one-off hit rather than a continuing decline in the rate of monetary growth. And one must mention all this. I would just say about India that although it's a very big economy in terms of its output, measured in terms of what economists call purchasing power parity, is not so important in terms of its impact on other economies. It imports less than Japan, Germany, UK and France. In terms of its trading and financial impact around the world, it's quite small actually. So perhaps one shouldn't get too alarmed about these developments in India. Finally, what about the UK? Small part of the world economy these days, but there has been too rapid monetary growth in the UK. There does need to be a reduction in money growth towards, say, 3, 4, 5% a year from its current figures, more like 5, 6, 7% a year. But again, I wouldn't get too alarmed, and I wouldn't get too worried about the global impact. So my verdict, when you go through these the six largest economies in the world, is that actually any talk about a global downturn in 2018 is a mistake. It has been amazing how since the Great Recession you've had this long period, now really quite long period of 6 or 7 years of low money growth, stable money growth, and also low and stable growth of nominal GDP. I can't see any reason for the moment to expect that to change in the next 18 months. These numbers I analyse are not suggesting any big movement, any big adjustment from that kind of pattern. Now, what about this place where there is some concern, and as I said, the Bank for International Settlements keeps on making these warnings about a build-up of financial vulnerabilities, as the way it characterises it. I would concede that China is one place where money growth has been about 10% a year. So they've got a rapidly growing economy in terms of the trend rate of growth of output. And also people are starting to save more and to have more money in the bank, and so the banking system is rising faster than GDP. So this kind of 10%, 11, 12% growth rate of money is not particularly high for them. Could it collapse? Now, the worries about China have been focused by a report in May from Moody's, the credit rating agency, where it reduced the rating of China's sovereign debt. The grounds were not that the Chinese government had lots of public debt, but that the private sector had too much debt. This was partly in the banking system. The government has an implicit guarantee on bank deposits, therefore, indirectly, there is excessive government debt, at least potentially, indirectly, and therefore Moody's gave this down rating of Chinese sovereign debt. The Bank for International Settlements has quantified this in what they call a credit-to-GDP gap. This credit-to-GDP gap is the total amount of debt by the non-financial sector, non-financial private sector, relative to GDP, where today, relative to the trend in that debt. And the idea is that if the debt's been rising too rapidly in the recent past relative to some trend, then there's too much of it. And then if there's too much of it, people, they're subject to a shock, will cut back on their spending in order to reduce their debt, and therefore this will lead to a downturn in the economy. There are some people who interpret the Great Recession in this way. In my view, they're wrong. That's why I've written this book. It wasn't caused by that, it was caused by a collapse in the rate of growth of the quantity of money. Anyway, this idea that too much debt is the debtism, is why I call it, is the source of the trouble, has been very influential in the last few years, and it has indeed been part of the justification for the demands that banks hold much more capital relative to their assets, the idea being that this reduces the risk to the system from there being too much debt around in some sense. I would just say here that these debtist ideas have no basis in traditional macroeconomic theory. They're a quite new set of ideas, whereas the monetary theory has a pedigree going back through centuries of high-quality thinking backed up by long runs of evidence, and in my view is a far more robust and serious body of thought. Anyway, let's just see whether debtism had anything to do with the American Great Recession. China is a bit of an unknown quantity still, but we've got lots of information about how the American economy behaved in the past. So was it true that too much debt caused the downturn in the American economy? What I'm using in this chart is some data published by the BIS, and I've compared the BIS estimates of the credit-to-GDP gap for the USA with what economists call the output gap. The output is the level of output relative to trend. If this set of ideas were correct, you would expect a high ratio of debt to GDP to precede a downturn in the economy. You see the picture. It's true that in the last downturn, something of this sort did occur. You can see that the peak in this notion of the credit gap, credit to GDP gap, occurred sometime in late 2000, perhaps late 2007, early 2008, and the American economy then had a recession which caused output to go well beneath its trend level. It's that big negative output gap in 2009-2010. So doesn't this theory work? No. Look, this is only one episode. To get a proper proof, a proper examination of whether a theory works, you need to test long runs of data. You need to look at it cycle after cycle, episode after episode. Only when you've done that can you say that the theory is robust. And what I've done here is to compare the BIS estimate of this credit gap. Let's concede to them and thank them for preparing these numbers, with the American output gap numbers prepared by the American Bureau of Economic Affairs, a government agency, going back to, when is it exactly? It is going back to 1962. Okay? What I've done there is put a line on this chart, a little gold arrow points to the line, and it's the period since that. This is the data, the chart I just shown you, the previous chart. We need to look at the track record of this credit gap idea before this recent episode. Doesn't work. There's no relationship between the BAS concept of the credit gap and the American output gap in the years from 1962 to 2006, 2007. It just doesn't work. This is not a general theory of the determinants of national income. In my view, we should treat it with a great deal of suspicion. Most credit transactions are concerned with decisions to borrow, which may then cause this excessive debt. Most credit transactions are involved with transactions in existing assets. You know, there's this idea that people borrow in order to binge, that they borrow in order to run a way of life that isn't sustainable. The great majority of decisions to borrow are in fact to acquire a capital asset, certainly in the case of most businesses. And for most people, the big form of debt is mortgages to acquire a house. Yes, sometimes it's to buy a car or a van or a lorry. Yes, they're capital assets. Okay? So the result of credit growth is usually that there is, in association with it, growth of the capital stock, and then the growth of the capital stock means that the debts are repayable. And indeed, if you look at, for example, American data, which I'm familiar with, you'll find that there have been periods in which the ratio of debt to national income has increased, and the ratio, that's gross debt, and the ratio of net wealth, that's wealth minus debt to national income, has also increased. Okay, it may sound odd, but that's possible. Obviously, if wealth has risen faster than national income, then the ability to repay the debt by selling an asset is obviously there. It is not the case that the rise in the debt ratio by itself demonstrates unsustainability, demonstrates a need for a retrenchment that may then cause a recession. It just isn't true. My conclusion from all this, we don't really know much as yet about how the Chinese economy will behave as it leaves this period of hypergrowth that it's had since 1980. But I would be very suspicious that the BIS notion of the credit gap really tells us very much at all. We've had these warnings about excessive debt in China off and on for the last 15 years. We certainly had one from BIS in 2013, now 4 years ago. These warnings are based on, not based on standard economic theory. In my view, they are incorrect, invalid, and wrong. Thank you.